Hi, welcome back to our YouTube channel, Merrill Talks. I will be your host today. I'm a portfolio manager of Merrill Funds. On our previous video, we spoke about artificial intelligence, electrical vehicles, but I think it's the right time to come back to our roots, which is macroeconomic. I will explore the current macroeconomic landscape, but before that, if you are interested on our discussions, please join our website, merrillfunds.com. Here. Any questions are welcome. Please feel free to put any comments on the section. Thank you. Before we start our journey on the investment, let me thank first Ike Collections for this beautiful place, Palazzo Consigna, in the heart of Valletta. Quick disclaimer before we kick off. The content of these presentations and be prepared for general guidance and information purpose only. Any information provided through this presentation do not constitute any financials, investor or professional advice or recommendations. Thank you. The inflation was a dominant thematic definitely in 2022. Now we are at the end of 2023, it's still present. Last year, I made an interview with the Time of Malta related to the state of the economy. The title of the article was US, the last domino to fall. When I describe it and I compare to Germany, who is in a difficult situations, and I describe it Germany as a vintage car on a bumpy road. We are not so far away from this image or metaphor. In today's agenda, I will explore with you what the sovereign bonds has to offer. As we know, US offer a very decent yield, and even here in Europe. Please have a look. Let's start our presentation with the positioning of the central banks. The first part represents the major developed economy, and the second represents two significant actors in the emerging market, China and Brazil. At the US at the top with a level of 5.5, which is the overnight rate, followed by the Bank of England at 5.25 and the ECB at 4.5. At the bottom, not a surprise to see Japan, Bank of Japan with a negative rate at 0.10. Since the beginning of the year, yen lost value against a significant other currency, even trading around recently 164 against the euro. The objective of this video is to put your attention on the sovereign bonds. But we cannot ignore the trajectory of the currency. Regarding foreign exchange here in the south of Europe, the tourism industry had a fantastic second year. The momentum remained intact, especially in the heart of Valletta, with flooding with American and Asian tourists. Let's explore together the central bank on the developed world and also in the emerging market. As we can see on the first part of the sections, we get the Fed, the Bank of England, the ECB, when they start their policy back to 2022 at a level of 25 basis points for the Fed, 25 basis points for the Bank of England, and flat for the ECB. When Switzerland had a negative rate back at that time to 0.75. Japan remained the same since 2022 with a negative rate of 0.10. Now, on the other part, which is two major central banks in the emerging market, the Central Bank of Brazil started its journey at 9.25, finishing at 12.25, and the Bank of China, PBOC, started at 3.8, now cutting its rate at 3.5. So what we can see, there is a divergence between emerging market and developing market and the central bank. Now, let's explore the next slide. I think it's an interesting thing because as an investor, you want to know where you want to put your money. And I think there is like very interesting level of yield here and you want to put your money there. As we discussed before the policy rate, let's now have a look about the 10 years yield. As we know, US is at the top of the list. Credit rating downgraded not long time ago by Moody's. Now the 10 years, if you want to put your money on the 10 years in US, you need to receive 4.45%. If you want to put on the UK government, the gilt, you will receive 4.13. Now, the difference in the Eurozone, as we know, we got the same policy rate for Italy and Germany at 4.5, which is the overnight rate. But the difference, obviously, it's the credit rating. You will receive from Italy at this moment 4.3, when in Germany you will receive only 2.6. At the bottom of the list, as usual, Switzerland, who's just offering a rate of 2.6, one of the lowest. You probably think it's not an attractive yield, but don't forget, and like I said last year on the same time on the video, for a currency aspect, the Swiss franc was the most resilient currency even against many currencies, the dollar, the euro, etc., etc. The residents of Switzerland kept their purchasing power compared to the European and even the Americans. So like I say, you just receive a lower yield, but you have also better resilience investing in Swiss francs. Now it's time. We have been discovering all the yield around the world, developed to emerging. I think it's time to stop a minute here to discuss US and Europe. The US government's growing deficit and higher bond issuance are raising expectations for future treasury supply. At the same time, demand is falling, partially due to the Fed quantitative tightening. Elevated treasury yield could strain the US fiscal situations, making interest payments more expensive and affecting the mortgage and corporate bonds. Stock valuations may also be impacted, and the risk of a deeper economic slowdown. I mean, this is a question we need to think about, and Moody's was downgrading US, so definitely the treasury market, it's a problem, and we need to follow very closely the auctions. Christine Lagarde, the president of the European Central Bank, indicated that the bank will not begin cutting rates for at least the next couple of quarters, despite the slowdowns in the inflation. It's a very important thing to say. As we know, the problem of Europe, it's the divisions, a lot of deep internal divisions, including varying budget policies among member states and diverse perception on how to tackle the inflations, has led to disparity in the economic growth and the macroeconomic divergence in the era of the Eurozone. Member states need to adjust their economic and fiscal policy without any ambitious and immediately effective revision of the Stability and the Growth Pact to prevent an imminent euro crisis. A gradual convergence of budgetary policy among the member states is suggested. Now let's explore a new slide. I think for many people, the spread between the 2 years and the 10 years is an indication how we got and if a recession is coming or not. Let's have a look at this chart. Inversion of the curve took place in September 2020-21. And as you know, a lot of economists say that when inversion is coming, recession shouldn't be too far away, around 12 to 18 months in front. So far, the economy is quite resilient, especially in US, in this curve. So we have to understand what's going on at the moment. Now, let's take time also to have a view about what's going on in Europe. Do we have any inversions? Yes, but the inversions took place later on, which was November 2022. Let's speak an instant, please, about the German economy, one of the two main engines of the European bloc. Despite a slowing growth and a poor economic survey, investor sentiment is more positive, hinting at an improvement in economic indicators by early 2024. However, some economists remain skeptical about a rapid rebound. We are clearly back on the track, and we can see the participation rate is at the top and even above pre-COVID in Europe. Just want to discuss and finish the presentation here with the Fed rate, and we can see here on the slide, and how we can expect. But this is, again, this is expectations. A lot of investors are expecting in 2024 a lot of rate cut from the ECB and the Fed.